What's up everyone, it's Karthik with MoneyVest. In this video, we are going to be talking about Tom Lee's latest interviews on CNBC and his entire expectations regarding whether the markets are in a bubble, valuations, small caps, and talking about technology and a lot about interest rates and what the expectations are from S&P 500 going into 2025. And I'm also going to be sharing my views and my perspectives. This is not going to be going over a lot of data, but simply going over very high quality signals and things that I'm really watching going into this new year of 2025. So hope you all enjoy this video, find it helpful. Make sure that you subscribe and also do check out free videos that are available for all of you. So this right here is my 2024 options portfolio final recap, pretty much finishing the year with a 32% gain for this portfolio, outperforming the S&P 500 by well over 6-7%. So again, all you have to do is join for free. This video is going to be available. And there's one more. This is going over my entire 2024 recap, not just for the options portfolio, but for the other two portfolios as well, long-term and both long-term growth and main fund, and as well as 6 lessons that I learned in 2024 that I think are going to be super helpful for you in your investing journey. So both of these videos, I've made them completely free. All you have to do is sign up with the link down below. You can join and watch these videos for free, both of them, nothing else. There's literally no payment required to watch these videos if you're interested. So this right here are all of my notes that I took from 2 videos that Tom Lee was on CNBC last couple days. And I really want to go over certain things that kind of stood out to me and again, kind of share my views and also poke some holes because, again, this is very important because as we know, the Tom Lee is almost always bullish on the market. Considering the last 200 years, the markets have been up over 75% of the times. And so if you are more bullish and more optimistic than bearish, your likelihood for success is significantly more and better than if you are bearish like Michael Burry. So first thing he says, there is a lot of tailwinds building for markets in 2025. He also talks about now we're not worrying about the Fed, worrying about inflation bringing the economy to a halt. So basically talking about 2025 being a very, very strong year and expecting for the S&P 500 to get up to over 7,000 in the first half of 2025. So that's pretty much the target that he's put together on S&P 500 in the first half. However, the second half, he is still a little bit more skeptical considering the markets are actually going to be closing lower than where we are from 7,000 onwards. He's also watching the CEO confidence going into 2025. He's expecting that number will restore and recover back over 50, essentially restoring confidence with the new administration. And he also goes on by saying that we have seen a lot of capital that's sitting on the sidelines and M&A activity, so mergers and acquisitions will pick up, which will help equities in 2025 as well. The treasury yields. Now, this is actually quite interesting. He says treasury yields above at 5%. Even then, it's not going to be damaging to the markets, which I'm not so sure if that is going to hold up with the markets, because at over 5%, he says that you're paying 20 times for a 10-year bond. And that is actually a very, very good rate for a 10-year treasuries. Like, think about it this way. It's not just investors wanting to beat the market. I think that's one thing that everyone has to understand, that there's a lot of different types of market participants in the stock market. It's not just people wanting to beat the S&P 500, right? So we always kind of look at investing as, oh, did you beat the market? Did you beat the S&P 500? But a lot of times you'll notice some of the bigger pension funds and endowment funds that are university institutional endowment funds, they're not looking to beat the market. If they do, great, but they can also be looking to beat what? Inflation. Some of these funds, they literally just want to grow faster than inflation. That's it. They don't want their purchasing power to be evaporated by inflation. And so if the 10-year bond is giving you a 5%, 5.5% return, inflation's at 2.5 or 3%, your real net return after inflation is still 2 percentage points over and above, which is fantastic, right? So you're still able to grow capital at 2% post-inflation. That, for many pension funds, endowment funds, is a steal. And so interest rates on the treasury yields at 10-year, 20-year, 30-year bonds, if it gets up to over 5%, in my personal opinion, could very well be damaging for equities, for growth stocks. We're already starting to see the effects of that as interest rates are hovering around 4.5, 4.6%. And so I have to disagree with a little bit there from Tom Lee that at 5%, it may not be damaging to the markets. Now, he also says that it's not clear why the yields are rising, right? So they could be rising because of a robust economy. It could be inflation. It could be that markets are concerned around incoming policies of the new administration around tariffs. So there's a lot of different reasons why interest rates could be rising. However, the US has seen many companies make bets in the right places. And that's really what's caused the United States to be very, very dominant player in the global markets. I mean, the US markets have been the best performing markets globally, and the US tech dominance is literally unmatched because if you look at some of the biggest companies in the German DAX or in the FTSE 100 in the UK, I mean, all put together, even those are not comparable to Apple or Nvidia. So just, over a $50 trillion market value for US stocks, again, just goes to show how strong the US economy and the markets are. And at some point, he says the valuations become a liability when market isn't able to be surprised. And this is actually literally spot on from Tom Lee. I've talked about this in one of my previous Palantir videos. I mentioned that if there is expectations that are really high and the markets are not able to be surprised, right? So if you're not able to surprise the market with the reality, what does that do? That creates disappointment, right? So always remember with investing and in life, if you are expecting the moon and you get something less than the moon, the reality is not as high as the moon, you're going to be disappointed. But you're expecting nothing and you get the moon, you're going to be pleasantly surprised. And so markets are nothing but, just a understanding of whether we're getting surprised or whether we're getting disappointed, whether it's a good surprise or a bad surprise or a bad shock. And so valuations do become a problem eventually, right? It becomes a liability if the markets are not able to be surprised, i.e. are disappointed. And he says that we're not there yet. This is not a market which he would say is in a bubble. So he says that we're not in a bubble yet. We're not there yet. However, valuation is not a problem just yet. And he says the last few years, investors were underpaying for technology and innovation. And 2025, he says, is the year we're going to find out the AI application is going to re-architect the way America does business, which is going to be a huge cost saving for a lot of these companies. And as a result, we're going to continue to see this AI boom and the revolution, revolutionizing the entire technology in 2025, which is artificial intelligence, take on another step forward. So that was kind of like some of the things he mentioned. Finally, he says small caps have underperformed against the S&P 500 by 91% in the last decade. This was the second worst performance since 1900s, and the last three worst instances that you see for small caps, kind of this level of underperformance, the next 3 to 5 years have been very bullish for small caps. So in other words, he says that we have discounted a lot of bad news into small caps. They're trading at 10 times forward price earnings multiple, and the probabilities are very high for small caps to do well going into 2025 because of how oversold and how disconnected they are from the reality. So, going into 2025, one of my big ETFs that I will probably be trading and will probably run the wheel strategy and might even take a lot of trades on is TNA. I do believe that small caps have a ton of potential. I exited out of my IWM for a 17% profit. I think I did the right choice because it was really trading sideways, and I want to have a little bit more exposure, leveraged exposure to small caps if there is potential in 2025. So TNA kind of offers that opportunity. But again, huge risk disclaimer. I want to flash warning signs. Be careful with this because it is leveraged 3 times. So of course it can go up by 3 times. It can also go down by 3 times. So I think it's really important to have proper risk management and trade management if you are looking at something like TNA. Now, finally coming over to something that is very, very important for my decision making, as I've already mentioned, and that's going to be the MoneyVest Index combined with our volatility understanding as well as S&P 500's RSI reading, which is a little bit of a market breadth indicator helping us understand the market conditions, whether we're oversold or overbought, and just getting us to a market temperature. That's really what it is. As I mentioned this before from Howard Marks, from Peter Lynch, from a lot of great investors, what do? They look at the present moment and they try to understand the market temperature. Are we overbought, oversold? Are we overvalued, undervalued? Are we expensive or cheap? Are we in euphoria or fear? That is the entire idea behind cutting out all the noise and focusing on high quality, no BS signals. And that's what the MoneyVest Index and that's what volatility really provides us. And so you can go back, do some back testing, look at 2024, look at 2023. Every time you've seen those buy signals get triggered, those have been nothing but great buying opportunities. The risk reward profile has been fantastic. You go back, track the S&P 500 alongside this index. You can actually do that over here. So this is the S&P 500's MoneyVest index, also on TradingView. And then you compare that to the S&P 500 over here. And you'll notice every single time we've been in that yellow or green zone has been a good buying opportunity because the markets have been down, let's say 8% or a little bit of a dip of 4%. This right here, a dip of about 3%. This right here, a dip of about 5.5%, right? So you get the idea. When we do get these prolonged bear markets like we did in 2022, we will still see some burst of upside momentum. 5% move to the upside. This right here, 4.7% move to the upside. And then eventually, of course, increasing by 7%. And then the rest is history, getting back up to all-time highs. But even then, you get a lot of really good buying triggers, buying opportunities to deploy capital into. So a lot of people, when they ask me, like, when's the good time to buy? Like, is this a good buying opportunity? It's all about assessing the risk and reward in the market. And we also have a different spreadsheet that helps us understand the percentiles for how many times the markets are actually down 5, 10, 20, 30, and 50% from their all-time highs. So in other words, when the markets are in a different threshold, right? So if you come over to market snapshot, right now, for example, if I show you, the S&P 500 is in a dip. What does that mean? It simply means that we're down more than 1% from all-time highs, but less than 5%. A dip means that we're down less than 5% from all-time highs. The moment we cross over 5, but less than 10, we are in a pullback, like the Dow is, right? So Dow Jones is in a pullback. But the moment we go over 10%, but less than 20, we are now in an official correction, right? So correction is anything over 10%, but less than 20. And every time you're down over 20%, we are in now what's called an official bear market, like a lot of stocks are. Like, for example, AMD, Qualcomm, Adobe, they're all in a bear market. And every time we're down over 50%, we are in an official crash, right? That's when stocks are going to be down like 60, 70%. And it's going to feel like the sky's falling apart and there's going to be just a ton of opportunities in the market. And that's what this index helps us track. It's basically helping us track all these great risk reward ratios and the buying opportunities in the market. And that's what I'm going to be doing is when the markets come down, when the risk reward gets better, I'm simply going to close my eyes, follow my MoneyVest index, and literally just take advantage of those buying opportunities. So that's it. That's all for this video. I would really encourage you to cut out all the noise. There's going to be a lot of fear mongering, a lot of recession calls, a lot of just unnecessary noise in the market, but focus on quality. Focus on literally just taking a step back, evaluating the market structure, understanding the market temperature. Are we overbought, oversold? Are we overvalued, undervalued, expensive, cheap? How is the market sentiment? Euphoria versus fear versus panic versus greed. So that is really what's going to help you separate yourself from the crowd. And so if you want to get access to all of this, 2024 was a blockbuster year for us. Link's going to be down below. These are free videos you can join and watch. 2024 options portfolio update as well with the entire final recap. Link's going to be down below if you're interested in joining us. And again, if you have any questions, my door is always open. Message me, email me, text me. I'm always available to answer your questions and help you through your journey of investing and trading in 2024. That's why I'm putting out a lot of free content on Patreon now as well. So link's going to be down below. As always, happy investing. I'll see you all in the next video.